Imagine buying a car. You wouldn't just look at horsepower, right? You'd consider other factors like safety features and fuel efficiency. Similarly, when investing in stocks, you need to look beyond just one metric. The P/E ratio is like checking the horsepower of a company. It's a good starting point, but it doesn't tell the whole story. Just like you wouldn't buy a car based solely on horsepower, you shouldn't invest in a stock based solely on its P/E ratio. You need to dig deeper and consider other factors, especially when it comes to bank stocks. The price-to-earnings (P/E) ratio is a popular valuation metric. It tells you how much investors are willing to pay for every dollar of a company's earnings. A high P/E ratio suggests that investors are optimistic about the company's future growth prospects. Conversely, a low P/E ratio may indicate that investors are less confident. While the P/E ratio is a useful tool, it's not a magic bullet. It's important to remember that P/E ratios can vary widely across industries and over time. Now, let's talk about banks. Banks are different from other companies. They don't make money by selling widgets or software. They make money by lending money and earning interest income. This unique business model makes the P/E ratio less relevant for banks. Enter the price-to-book (PB) ratio. This metric compares a bank's market value to its book value, which is the value of its assets minus its liabilities. The PB ratio gives you a sense of how much investors are willing to pay for every dollar of a bank's net assets. Interest rates are the lifeblood of banks. When interest rates rise, banks can charge more for loans, boosting their profits. Conversely, when interest rates fall, bank earnings tend to shrink. This sensitivity to interest rates can make bank P/E ratios volatile. For example, during periods of economic expansion, central banks often raise interest rates to combat inflation. This can lead to higher bank earnings and, consequently, higher P/E ratios. However, during recessions, central banks typically lower interest rates to stimulate growth, which can weigh on bank earnings and P/E ratios. The PB ratio is a more stable metric for valuing banks because it focuses on their assets. A bank's assets primarily consist of loans which generate interest income. The book value of these assets is relatively stable, even when interest rates fluctuate. To calculate the PB ratio, you simply divide the bank's market capitalization by its book value per share. A PB ratio of 1 means that the market is valuing the bank at its book value. A PB ratio above 1 indicates that the market is willing to pay a premium for the bank's assets, while a PB ratio below 1 suggests that the market is discounting the value of the bank's assets. PE versus PB, the prudent investor's checklist. Let's say you're comparing two banks, Bank A and Bank B. Both banks have a PE ratio of 15, however, Bank A has a PB ratio of 0.8, while Bank B has a PB ratio of 1.5. Based on the PE ratio alone, both banks might seem equally attractive. However, the PB ratio reveals a different story. Bank A is trading at a discount to its book value, suggesting that it might be undervalued. On the other hand, Bank B is trading at a premium to its book value, indicating that it might be overvalued. In conclusion, when evaluating bank stocks, don't just rely on the PE ratio. Consider the PB ratio as well. It provides valuable insights into a bank's financial health and its valuation relative to its assets. So, the next time you're looking at a bank stock, ask yourself, what's the PB ratio? You might be surprised by what you find. Don't forget to hit that like button if you found this video helpful. And if you want to see more videos like this, be sure to subscribe to Budget to Billion.